India's GST Council unanimously approved a historic restructuring of the goods and services tax system on September 3rd, raising the levy on carbonated and caffeinated beverages to 40%, while dramatically cutting taxes on everyday essentials. The reforms, taking effect September 22nd, represent the most comprehensive overhaul of India's tax structure since GST implementation in 2017. Popular soft drinks, including Coca-Cola and PepsiCo products, will become significantly costlier as the GST Council moved carbonated beverages from 28% to the new sin goods category at 40%. The increase also applies to caffeinated beverages, aerated waters with added sugar or sweeteners, and all non-alcoholic flavored drinks. The tax hike represents a major setback for beverage companies that had vigorously lobbied against being classified as sin goods alongside tobacco and pan masala. The Indian Beverage Association, IBA, representing Coca-Cola, PepsiCo, and Reliance Consumer Products, had specifically requested a sugar-based taxation model to differentiate between high-sugar and healthier low-sugar alternatives. The existing taxation ignores low-no-sugar variants and fruit-based beverages, which offer healthier alternatives, the IBA wrote to the Finance Ministry in August. The association noted that over 55% of PepsiCo India bottling partner Varun Beverages sales now come from low or no sugar drinks. Despite industry arguments that carbonated drinks have become mass consumption items, with 71% of transactions at 20 rupees or less and 65% of consumers from lower socioeconomic groups, the GST Council maintained the sin goods classification. The decision contradicts industry hopes for inclusion in the 18% standard rate category. The reforms simplified India's four-tier GST structure into primarily two slabs of 5% and 18%, with the special 40% rate reserved for luxury and sin goods. Finance Minister Nirmala Sitharaman emphasized the change's focus on benefiting the common man, with around 175 items becoming cheaper. Essential items including hair oil, toilet soaps, toothbrushes, and bicycles moved to the 5% category, while ultra-high temperature milk, paneer, and Indian breads became completely tax-free. The overhaul reduced rates on 33 life-saving medicines to 0 and cut television, air conditioner, and small vehicle taxes to 18%. Notably, while the increased rates for most goods take effect September 22nd, tobacco products including cigarettes will continue at existing rates with compensation cess until pandemic. Related loans are fully repaid, expected by year-end. Once loans are cleared, these products will also move to the 40% slab without additional cess. The comprehensive restructuring coincides with the Trump administration's 50% tariff on Indian goods, implemented August 27th, positioning the domestic tax cuts as a strategic response to boost consumption amid trade pressures.